Hi, I'm Ross from Smith Chartered Accountants in Hamilton. We're a firm who specialise in property investors and help just normal mum and dad investors who own 1 or 2 properties through to larger property developers, builders. So just a quick disclaimer, this is really just for educational purposes and it's of a general nature. So if you need specific advice, you need to come and talk to an expert. So you've probably been wondering, how can you save $17,194 in tax? Interesting thing, over 85% of property investors are actually not doing this. So there's only about 15% of property investors are doing this simple trick. From the 1st of April 2011, there is no more building depreciation. So therefore it becomes a lot more important for us to consider chattel's depreciation and what we can do with it. So what is chattel's depreciation? Generally, for a lot of investors, we get a chattel's valuation done through a firm called Valueit, and their details are on the website www.valueit.co.nz. And basically a chattel's valuation or valuer breaks the property down into all its different chattels. So there's the 5 big items: carpets, curtains, dishwasher, stove and heat pumps. They're the sort of main items I look at whether a chattel's valuation is worthwhile, but you also get a lot of smaller items. You even get things like the clothesline, the TV aerial, paths, driveways, fences, mirrors, any item that's basically separate to the building itself and can be a separate asset. So what we're looking at is basically chattels can get depreciated a lot higher. So for example, if we're buying carpet, depreciation rate on carpet is 25%. So in real simple terms, that means if you buy a carpet for $4,000, you're going to get a $1,000 deduction each year over the next 4 years. So getting down to the numbers a little bit, if we don't get a chattel's valuation done, no depreciation on buildings, we're going to get no deduction whatsoever. Whereas if we get it done, just on this carpet, say we buy $10,000 carpet, depreciation at 25% means we're getting $2,500 depreciation. And that's in the first year. So we're going to save about $750 in tax if you're on a 30% tax bracket. So that's just the first year. You're then obviously going to get the 2nd, 3rd, 4th year where there's going to be no extra cost for that. And what happens with depreciation is the depreciation slowly gets less and less and less over time. So your deductions will get less, but you're looking at doing this for one-off cost. So even if you just had some carpet that's worth $10,000, the benefit you're getting in 1 year is $750, cost $400. It makes really good sense. So any high level property, any newer property, it really makes sense to get one done. For older properties, it can sort of be a grey area and you really look at those main items. Another plus is there's generally no recovery on chattel's depreciation. So some of you would have been in property investment for a long time and you'd know about building depreciation and also recovery on building depreciation when you sell your property. Well, with chattel's, they do actually wear out. So if you buy brand new carpet for $10,000, in 10 years time, it's going to be worthless. It's going to be worn out. So with chattel's depreciation, you get to depreciate it higher, plus you get to keep that, which is really good. So we've got a couple of examples here for clients. So these clients have owned their properties for probably about 5 years now, and they've got 3 properties. They're reasonably new properties, reasonably good properties, and over that period we've claimed $79,001 in total chattels claimed. It saved the client approximately $26,000 in tax. So yeah, it probably cost them $400 for each times 3 properties, so $1,200 to get the chattel's valuation done, and giving them a benefit of $26,000, so it's a 2,167% return on investment, which is obviously fantastic and obviously very worthwhile in that case. A second example, this is a brand new property up in Auckland, just one property. Over the time they've claimed $30,969 chattel's depreciation and saved about $10,000 in tax. Where this example is slightly different is if we had have depreciated the equivalent building, we would have got $7,000 as well, which is great. So we would have got 7 instead of 30, so we're down quite a lot. But the big thing is when we sold this property, Building depreciation, the building actually went up in value, so we would have recovered all that depreciation and we would have had to pay tax on that recovery. Whereas with the chattels, we actually got to keep that because the chattels wore out in value and reduced in value, so we get to keep that depreciation. Example 3, and this is where the $17,194 comes from. It's basically a very simple commercial building. It's actually in Cambridge and Waikato. Over 3 years, we've claimed $52,102 in chattels depreciation, saved us about $17,194 in tax. Which is fantastic. For commercial buildings, you can actually depreciate a lot more. So we can depreciate your internal walls and your partitions. We can depreciate the electrical. We can depreciate the plumbing. So there's a lot more things than what we can do for residential depreciation. Cool, thank you for joining us. Yeah, have a look on our website. You'll find other great information on there. And yeah, make sure you sign up to our newsletter so that you get more tips and tricks like this. Thank you.